Okay, welcome to the webinar for taxation and Australians in Canada. I get asked a lot of questions regarding the tax issues for Australians in Canada. I figured it would make sense to put together a short webinar, try and help as many people as possible understand the situation. Short introduction. My name is Jonathan Bell. I'm the managing partner at Phillip and Company. We are a Canadian CPA firm. We're based in Toronto, but we have clients all across Canada and outside of Canada as well. I'm a Canadian CPA, originally a CA, a chartered accountant, with about 25 years of experience in public practice. I started my career at one of the big four accounting firms. We are a small firm dealing with mainly individuals and businesses. We do a lot of tax planning for owner-managed businesses. So I also have a lot of experience with residency issues, dealing with taxpayers who have cross-border issues. They have taxation in Canada and they have taxation in other countries. Specifically, we have a lot of clients, who are Australians who have moved to Canada, and we have a lot of experience dealing with the Canada-Australia tax treaty, which we'll touch upon, as well as dealing with foreign tax credits. As we'll see, foreign tax credits are a complex area of taxation, and this is really something we have a lot of experience in. Just a quick disclaimer, please do not rely on any tax advice given here. Everything here is general in nature. Everyone's situation is different. I urge you to seek competent professional advice, especially with someone who has experience with residency issues and cross-border taxation. Okay, so let's jump right in. I get asked all the time, okay, so I'm Australian. I just moved to Canada. I've been living in Canada a number of years. How do I file my taxes where do I file my taxes? Do I file in Australia? Do I file in Canada? Do I have to file in both? If I file in both, how do I ensure I don't get taxed in both? So the key to all of this, the first thing we have to look at, and this is really where the tax treaty starts, it begins with, okay, what is your tax residency? So you may be living in Canada right now, or you may be living in Australia, but that doesn't necessarily mean that that's exactly where your tax residency is. The tax residency is determined by the law. It's determined by the tax treaty. People often quote, they say, well, I spent more than 183 days this year in Canada, or less than 183 days. That's not really the overriding factor when it comes to the tax treaty. The real issue is, where are your major residential ties? Where is your center of life? And the tax treaty looks at some of these major ties. They look at major ties. They look at minor ties. So your major ties would be, well, where do you have a home available to you? Is your home in Canada? And the answer may be, some people say, okay, well, I have a home in Australia and in Canada, or I may have a temporary home in Canada. Where is your family? Do you have a spouse? Are they in Canada? Is the spouse in Australia? Where do you have children? Where are they? Are they dependents? Are they with you in Canada? Are they still back in Australia? So it really looks at, where is your center of life? Where do you consider your home to be? And a lot of this is to do with intention. I may intend to be in Canada just for 1 year, for example, and go back. So even though right now you may say your center of life is in Canada, but your intention is that your center of life is perhaps in Australia. So when it comes to intention, so it's very hard for CRA or for the Australian Tax Authority to prove where is your center of life, which really means that residency can often be a gray area. It can often be an area where you can't say, okay, it's exactly like this or like this, and it really needs, and often would need, a professional to assess the situation. So let's say, for example, a lot of Australians come to Canada on the working holiday visa. Classically, they're in Canada for 1 year. maybe 2 years. They've come, used it as an opportunity to work abroad, to, explore North America, and they're living in Canada for, 1, maybe 2 years. And really their intention is to go back to Australia. There are a lot of individuals like that, but although they're living in Canada right now, their center of life really is still in Australia. And typically such an individual would be a non-resident of Canada for tax purposes, and would continue to be a resident of Australia for tax purposes. And we'll explore, what the difference is between those two. Um, on the other hand, you have somebody who perhaps, has moved to Canada, and they say, listen, I really want to make, my life in Canada. Perhaps they're working towards, PR to permanent residency in Canada. They're trying, perhaps they have a house in Australia, but they've rented it out, and they're really trying to, make a go of it in Canada. It's common that, it's often, I would say, in such a situation, well, you're probably a tax resident of Canada, and which would make you a non-resident of Australia. You really can't be a tax resident of both places because the tax treaty would ensure that there's a tiebreaker, and would push you to one side or the other. So those are really the two extreme examples. One would make you a tax resident, here, and not a tax resident there, and as opposed to the other way around. So okay, so let's say we figured out where is your tax residency. So what difference does it make? So this is why it's very important. A tax resident of Canada, let's say we're taking the person who's moved to Canada, they want to, this is their center of life, they're working towards permanent residency in Canada. This is now considered, they consider Canada to be their home. So you are a classic resident of Canada, tax resident of Canada, and you're pretty much like every other Canadian in Canada. That means you would file regular resident Canadian tax return. However, you also, like every other Canadian, have to report your worldwide income, which means that if you have income in Australia, let's say you have investments in Australia, you have a business in Australia, you have a rental property in Australia, and you're making money in Australia, making income in Australia, you also have to report that income on your Canadian tax return because you're taxed on your worldwide income. Doesn't matter where the income is. That's how you are taxed in Canada. So this is where people, become a little alarmed. Okay, well, I also have to pay tax in Australia. My accountant in Australia told me I also have to pay tax in Australia on that income, which is correct. The reason is because it's Australian source income. So let's say, for example, rental property. You have a rental property in Australia, which is very common for people moving over to Canada. They hold on to their real estate. It may make a couple of years, may take a couple of years before they make the decision as to, if they're going to sell that property. So yes, you will be taxed on the rental income in Australia, and you also have to report the rental income on your tax return in Canada. So how do I avoid the double taxation? Again, that's where the tax treaty comes in and gives you a foreign tax credit in Canada. So in Canada, you can claim a foreign tax credit on the tax that you've paid in Australia. And we'll touch on that a little bit more soon. Can be quite complicated. So that would be somebody who's a resident of Canada. So they're reporting pretty much every penny that they earn, whether it's in Canada or in Australia or anywhere around the world. On the other hand, the individual who's a non-resident of Canada for tax purposes, like we said, somebody who's here, let's say 1 year working visa, and then is going back to Australia, they file in Canada as a non-resident. They file a non-resident tax return, and you only have to report your Canadian source income. So, for example, if you're employed in Canada, you're likely can receive a T4. You're on payroll, so at the end of the year, you would have to file a non-resident tax return in Canada. It's a different kind of tax return, and then you're only reporting your Canadian source income in Canada. I caution you that the non-resident tax returns can be a little bit complicated. Unfortunately, they also have to be paper filed, and unfortunately, the CRA are a little behind, a little slow when it comes to dealing with non-resident, because it's paper filed and the system doesn't work as well. Could be quite frustrating to deal with when it comes to non-resident returns. But anyway, that's a non-resident would have to file a non-resident return in Canada. So really, the taxation in Canada is more simple because you're not reporting your worldwide income. However, where you're going to find it's less simple is on the Australian side, because you continue to be a tax resident of Australia. So in Australia, you're going to have to report your worldwide income, which would include your salary, your T4 income from Canada. And on the Australian side, you're now going to have to claim a foreign tax credit with the ATO. And on your Australian tax return, try and ensure that you're not double taxed by claiming your Canadian taxes as a foreign tax credit in Australia. So although the Canadian side is pretty simple, you're going to report your Canadian source income, the Australian side will actually become more complicated. So we mentioned, a regular resident of Canada would report their worldwide income and claim a foreign tax credit. Now, foreign tax credits are pretty much the number one area where CRA like to ask questions. I can, have a lot of experience with this, and I can tell you that in 95% of the time you file a foreign tax credit, you're guaranteed to get a letter from CRA saying, okay, prove the foreign tax credit. And when they say prove the foreign tax credit, it doesn't just mean, okay, here's the taxes I paid in Australia. You have to show the source of income. You have to show a filed Australian tax return. They're not just going to go by, well, my accountant told me I'm going to have to pay this in Australia. You have to show a filed tax return, and you have to show a notice of assessment to show in Australia from Australia that the return was assessed the way it was filed. Now, so that itself can be complicated. The real issue is that, as we know, in Australia, there's a different tax year end. In Canada, you have to report your worldwide income for the calendar year. So let's say in 2024, you have to report your calendar from January to December 2024. The problem is that income that you earned in calendar 2024, well, that crosses 2 years in Australia. It crossed that income was included on your tax return for June 24 and will be included on your tax return for June 25. So it's not so simple to say, here's my tax return, because by the time you claim this foreign tax credit in Canada, let's say you're filing April 25, you're going to file your 24 tax return. Well, you don't have your Australian tax return for the second half of calendar 24, which means that CRA could well deny your foreign tax credit, and I've seen this happen, many times. How do we get by this? Well, often we'll say, you know what, we won't claim a foreign tax credit right now because it's just going to waste a lot of time. It's going to waste professional time answering the questions, and we're going to get a question from CRA that we can't answer because we don't have the tax returns to cover the second half of the year. Often I would advise clients, you know what, let's not report the foreign tax credit right now. Let's file without it. Again, it depends on cash flow, depends on the situation, depends on the kind of income. But often we will say, you know what, we'll just wait to get that. Wait till we get the actual tax returns. It may take until 2000, and it may take until later in 2025. At that point, we may go in and adjust, the Canadian tax returns to claim the foreign tax credit. Then we'll get a letter from CRA, but at least at that point, we have the information to answer the question. So yes, we are very careful when it comes to foreign tax credits, because CRA love to ask questions, and they attack, and they don't give in that easily when it comes to claiming a foreign tax credit. And real estate itself really is probably the number one issue that people have. Australians moving to Canada, as I said, it is very common for Aussies to hold on to their property, while making a life for themselves in Canada. Perhaps they'll sell it a couple of years after having moved to Canada. Again, you have this issue of paying tax in Australia because it's Australian income, Australian source income, but still having to report the income in Canada. Another issue when it comes to real estate is that the cost, we need to figure out the cost basis of the property to you in Canada. It's not the same as the cost basis in Australia, which would basically be the amount that you paid for the property in Australia. Your cost basis is important in Canada, and it's the fair market value of the property when you moved, the date you moved to Canada. And that number becomes important for eventually when the property gets sold. The gain, the overall gain will be different in Canada than it will be in Australia. It affects the tax depreciation that you may claim, CCA, on when you report your rental income in Canada. And it also affects the T1135, which will the statement of foreign assets, which we'll touch on in a moment. The sale itself is an interesting situation because you end up having, as I said, you end up having a different capital gain in Canada than you do in Australia. I've actually had a number of clients where the fair market value when they moved to Canada was X, and then when they sold the property, actually it was below. The selling price is actually below that. Let's say real estate had fallen in the a couple of years that they were in Canada. It ended up that they actually showed a gain in Australia. They could have had the property for many years and had a capital gain in Australia, but actually ended up with a loss in Canada, which is a very unique situation. And some clients ended up using that loss. We were able to use the loss, a capital loss. There's a capital loss. There's a business loss. You have to split out land and property, land and building. But they were able to actually apply some of that loss to their general income, even though they sold the property for a gain. But again, when it comes to the sale of property, you're going to likely deal with foreign tax credits because you're paying tax in Australia on the gain, and you probably will be paying tax in Canada on the gain, and that also becomes quite complicated because you have different overall tax basis for the property in Australia and in Canada. We mentioned the T1135. This is something to be very careful of as an Australian Canada or anyone in Canada who has foreign property. So, for example, the T1135 is required if you have foreign assets more than $100,000 at any time in the year. So, if you have a rental property in Australia, then that's pretty much guaranteed that you have more than $100,000 of assets, and you have to file the T1135. You're not paying tax on this T1135. Obviously, you're going to pay tax on the income on your regular tax return, but the T1135 is a statement of assets that you would have outside of Canada. So at that point, once you hit the threshold for filing 1135, you then have to report any asset that you have, any financial asset or business asset that you have outside of Canada, and that would include any bank account, any investment account. You suddenly have to list those accounts on the T1135. I caution you to be very, very careful about the T1135 because the penalties are huge. If you are, significantly late for an 1135, the penalty could be $2,500 for each missing T1135. So, for example, I've had clients come to me, a husband and wife. They've been in Canada for, let's say 5 years, more than 5 years. They had no idea they had to, they had foreign assets. They had no idea they had to file the T1135. So they were looking at, about a $15,000 penalty each, $30,000 in penalty just for not filing this T1135. So thankfully, there is a process that CRA has called the Voluntary Disclosure Program, the VDP, and we were able to, and I've taken a lot of clients through that, whereby if as long as CRA have not asked you, okay, where's your T1135, you can then go in and file voluntarily and hopefully mitigate the penalties. But again, it's a very specific program, and I caution you to be very careful with that, or you could end up with serious penalties. Some other issues that Australians typically have, they ask like the super, usually an Australian super The income does not have to be reported in Canada, but again, you would likely have to report that on a C1135. So a lot of Australians say, listen, I moved to Canada. I'm a sole trader in Australia. I'm working in Canada, but I still have Australian clients. So again, if you're a tax resident in Canada, you have to report your worldwide income. The question is that Australian income or is it Canadian income? And it makes a difference. Do you have to report it in Australia as well? Chances are, again, it's something that has to be assessed by a professional, but chances are, if you're sitting in Canada, in your house in Canada, and even though you're dealing with Australian clients, chances are that's Canadian source income. Again, you'd have to figure that out for the Australian tax return. I have a lot of individuals who say, listen, I'm still employed in Australia. I'm still, getting, employed my salary from Australia. That it becomes very complicated because again, you're sitting in Canada being employed, so it means it's really Canadian source income. But if you're paying payroll taxes in Australia, that usually means that they're deeming it to be Australian source income, and it becomes quite complicated to sort out that situation. Again, similarly, we have clients who have businesses, they're still running businesses, let's say in a corporation in Australia. You have to be very careful, it's very complicated because now you're a Canadian resident controlling this corporation, and likely that the corporation would have to file in Canada. Perhaps it's something that you want to try and avoid. It does become quite complicated if somebody does have a business like that in Australia. I've seen a lot of Australians. It's very common for Australians to have trusts we do have trusts in Canada, but it seems that they're more common in Australia. For example, a lot of individuals own shares of a private company through a trust, or they inherited real estate that is in a trust in Australia. Again, you have to be very careful because such a trust could now deemed to be a Canadian trust because you are Canadian and perhaps you're a beneficiary of the trust, or you contributed to the trust, and now it's deemed to be a Canadian trust. That itself is very complicated, and the trust itself may have to file in Canada. A lot of people miss that, and again, you may want to consider the voluntary disclosure programs because the penalties are very significant. One other issue I just want to raise is, if you are a tax resident of Canada and you decide, okay, listen, time's up, we're going back to Australia, didn't work out, we're going back to Australia, you do have to be careful about the possible departure tax, whereby Canada would tax you on on leaving Canada on any unrealized gains itself. It's a complicated process, but it's likely that you did have some sort of departure tax, in Australia, which would affect the way you actually report capital gains in Canada, would affect the way you report your capital gains in Australia. These are all issues that that need to be dealt with a professional. I hope this is a useful session. I tried to cover some of the basic questions. Again, as you can see, really each of the topics that we've covered really has a lot underneath the surface. Feel free to reach out to me via email, or you can look at our website. Actually, we offer new or potential clients a 15-minute free Zoom consultation. You're welcome to book that online at our website. You can book it at your own convenience. I will speak to you about your situation, and again, there's no obligation. You can decide if we are a good fit for you. Again, this session was really just to put out information to try and answer some of the basic questions. You can follow up with me. You can email me jmbell@philipca.com. You see the web address, our website there. My email is jmbell@philipca.com. Again, if you go there, you can book a Zoom session with us, a 15-minute complimentary Zoom session for you to decide what's right. Anyway, I hope this is useful, and best of luck with everything in Canada.